So tonight is the final review. It means your final is approaching. When's the date of your final? Just out of curiosity.
It's on the April 30th.
Oh, it's far. Yeah, time to forget.
I have another big final like right the day before.
ACCO320, I heard it was like a day one after the other.
Yeah.
Yeah. At least I have time to study. That's the positive I can see, but you also have time to forget. So I do a little bit every day, every 2 to 3 days, just do a problem so you don't forget before your final. So tonight, all we're gonna do is final problems that were on past finals. And throughout it, I'm gonna put some like little reminders for the theory if I think it's needed. So the first question is on chapter 15 and 17. So equity and EPS. They're normally like pretty much linked together in the final question. So you'll maybe have like transaction to do in equity. And then after that, they're gonna ask you to calculate the dividends. Then after that, they're gonna ask you to calculate the basic EPS and then the diluted EPS. It's like one big question. But it's always the same type of equity transactions, like your journal entries will always look the same. Your dividends, like be ready to calculate if the preferred shares are cumulative, non-cumulative, participating fully or partially. And for basic EPS, you're gonna have to find your weighted average number of common shares. That's always the same type of transactions that happen. And for diluted, you're gonna have a convertible preferred share, you're gonna have a convertible bond, you might have one or two like financial securities like the warrants or put options. So big question, can be really time consuming. So be like when you're doing your exercises and problems, time yourself to see how long it takes you and try to every time beat your time. So you don't lose too much time on your final on this question because I find this chapter to be a little bit easier than maybe chapter 18 and 20 where it's a little bit more confusing. So time yourself and see if like you would be good for your final. So that was my little disclaimer about these two chapters. So let's get started on the problem. Sona and Bats Inc. reported the following securities December 31st, 2011. Common shares, there's 100,000 outstanding. Preferred shares, $3 dividend cumulative, and there's 30,000 shares outstanding. These shares were also convertible into common shares, 5-for-1. Dividends on these shares are paid quarterly on March 31st, June 30th, September 30th, and December 31st. There's a 6%, 1,000 convertible bonds outstanding at par value, 3 million. The bonds are convertible into 60,000 common shares. Annual interest on the bonds is payable on December 31st and amounted to 150,000. 25,000 warrants, each entitling the holder to purchase 8 common shares of Sona and Bats at $21 each. 15,000 put options, each entitling the holder to sell 2 common shares of Sona and Bats at $18 each. The company had issued 40,800 common shares on March 1st under takeover agreement wherein Sona and Bat bought all of the operating assets of Bulls Corporation. On April 1st, some of the preferred shareholders exercised their conversion rights and the company issued 50,000 common shares to them. On April 30th, the company declared a 3-for-1 stock split for common shares. All conversion and price variables were also adjusted proportionately. On May 1st, the company repurchased 21,750 common shares in the market and canceled them. Assume the average market price of the common shares to be $15 per share before taking into account the effect of the stock split. Dividends on the preferred shares were declared and paid when they came due to all preferred shareholders existing on the dividend date. The company reported a basic EPS of $1.20 in 2012. There were no extraordinary or discontinued items to report in 2012. The tax rate was 40%. The first requirement is to determine the weighted average number of common shares to use in calculating the basic EPS. So we'll do that. So when calculating the WACC, always do your little table where you have the date, the number of shares, the time that it was at that number of share, your split or dividend effects, and finally the average. So first we want to look at our beginning balance for our shares. So what was in the books on the first day of the year? January 1st, 2012. The opening balance was 100,000. So that's what we're going to put here for the number of shares. Let me just do something real quick. All right. Then we're going to look at the additional information section, where they basically tell us everything that happened in the equity section for the year. So I'm going to take them one by one and see if they have any impact on my WACC for the year. First thing, on March 1st, the company issued 40,800 common shares. That means that they increased their share capital by this amount. So here, my balance is now going to be 100,000 plus the 40,800. I'm going to calculate the time at the end and the average also at the end. Then on April 1st, some of the preferred shareholders exercised their conversion rights and the company issued 50,000 common shares to them. So they increased their share capital for the common shares by 50,000. So it's going to be my balance from March 1st plus 50,000. Then on April 30th, there was a 3-for-1 stock split. So what happened is that one common share becomes now 3. So we're going to do ×3 at the amount of common shares we had previously. And also we're going to do ×3 to all our previous balances of our common shares that we put in our table here. So on April 30th, we did this amount ×3, so the 3-for-1 stock split. And I'm going to come here and add a 3 in this column. Why we're doing that is because the number of shares increased, and we want to reflect that also in all the past common shares transactions, because the common shareholders, they now all have 3 times more shares, but at the same total dollar value. So if we're calculating the basic EPS, which is how much per share that the common shareholders has, how much of the earnings they should receive, well, if we don't adjust the previous balances, when we're going to calculate our average, it's going to be lower than what it should actually be. So you want to come and restate all the previous balances by 3. If it was a 2-for-1, then we would do 2. If it was, instead of stock split, it would be a reverse stock split, where it's like instead of 3-for-1, it would have been 1-for-3. We would have divided this by 3, and we would have divided all of these by 3 also. So you want to reflect whatever happens, you want to reflect it in your previous balances of common shares. All right, so on May 1st, the company repurchased 21,750 shares. So that means I decreased its share capital by 21,750. Here you don't have to restate it. You don't have to come and put a 3 because the stock split happened before they repurchased the share. So you don't need to come and adjust it at all. It's already taken into consideration. And then that seems to be the last transaction for our year for the common shares. So now I'm going to come and put in the time period that the number of shares were at this amount in our books. So here on January 1st, there was 100,000 shares during the month of January and during the month of February. So that was 2 months out of the 12 months. So I'm going to come here and put 2 divided by 12. And maybe I'll add the decimals. Then on March 1st, it stayed at this amount for 1 month because the next transaction was on April 1st. So I'm going to do 1 divided by 12. Then April 1st, it stayed at this amount for 1 month. So I'm going to do 1 divided by 12. April 30th, here, the next transaction is May 1st, right? And it takes into consideration our balance on April 30th. So here I'm going to put 0 at the time because it's going to be counted into the May 1st calculation. If you want to account for this and put a time, then you would have to do, instead of doing months, you would have to do days and do like 60 days divided by 365 for January 1st, for example. And here you would have 1 divided by 365, but it's too precise and it's not material enough to like do per days instead of per month. So instead, I'm going to do May 1st. This amount, it stays like this for May, June, July, August, September, October, November, December. So 8 months out of the 12. And that column should give us 1. If it doesn't give you 1, just go back and make sure that you put the proper amounts of months. Once this is done, I'm going to find the average number of shares for the year. So for each little row here, I'm going to do the number of shares times the time and times if there's any split div effects. I'm going to skip this one because it's taking into account into the May 1st. And this one, I'm going to do this times this. And then I'm going to add all of my average numbers here. And that will give me the weighted average number of common shares for the year. So for 2012, they had 500,000 common shares on average outstanding. Any questions for this?
There was an in the videos that was available in the all section. There was another way to do it. I'm not sure if you know that way. They put the number of shares. They don't add the share at the beginning. They put all the shares. Then they use like the amount of month that was the time was that you use the amount of month that you first got in. So basically the time went like was decreasing. If the 100,000 shares started on January 1st, then it was accounted for the whole year because it started at the beginning of the year. And then they did an addition, and then they do the split, and then they continue calculating. I'm not sure if you could explain that or if you know that method.
I don't know that method and doesn't ring a bell, but what it seems is that they're also doing a weighted average calculation, like just an addition, but instead of doing it in the table, they're just doing it on the long. So maybe they're doing like 100,000 times 2 divided by 12. Let me know if I'm wrong.
No, it's not like that. Rafi knows that method better.
Yeah.
Yeah, it's basically what you're gonna do, like write 100,000 on the shares, like so because it's the beginning of the year. So basically, you're gonna calculate it for the whole year. So basically, this times 12 out of 12, so 1 year. So yeah. So for the next one, for the next one, you're gonna do like 40,000, times 10 over 12. Yeah.
Okay. So I understand why they're doing it. It's just another way of doing the weighted average calculation. So what they're doing basically is that you're gonna have the 100,000 shares for the whole year. It's in fact, it's for the full year. So that's why you're doing times the full year. You're adding in the 40,800 shares on March 1st. So its effect is only going to be on 10 out of the 12 months of the year. So you're going to do times 10 out of 12. And then you do the same thing here. For April 1st, you issued
It's 9/12.
Exactly. So it will be 9/12 because the 50,000 is only for 9 out of the 12 months. It's just another way of doing the same calculation. And then my guess is after they're doing these, like if I'm doing April 1st too, they're times 3, this amount.
No, it's the sum. It's the sum of those times 3.
Yeah, to take into account the split div. And then after that, you're doing the May 1st for 8 out of 12 months. So then here on May 1st, you repurchased 21,750. So it would be minus 1,750 times
Times 3. What's times 3? Times
no.
8 out of 12, then times 3.
Even if it happened after the stock
No,
split?
no, no.
No?
You don't have to time it by 3. Yeah.
Yeah, see, because here after, if I add the 2 together, it gives me the same number here.
So which method is better understood?
Well, I'm more used with this one, right? I just learned this one on the spot. So for me, it's this one. But if you're more comfortable doing it this way, and for you it's faster, do it that way. I cannot really recommend one over the other because it really depends which one you practice with and which one you learn and which one you're comfortable with. But they do come out to the same amount of shares at the end. Any other questions on the? I see that Professor Ben Ali teaches stuff differently than how I learned it. So Simon, I know you always have questions on how I do my stuff because I didn't learn it from her. So always, if you see that my method is different, do the one that you're most comfortable with.
Oh no, Ben Ali did not teach the second method. That was from the video that was available on the all section.
Okay, okay. Well, do the one you're.
It's Kelly Chiara.
Yeah.
Yeah.
All right, so we'll do requirement 2, which is determine the amount of dividends declared and paid to the preferred shareholders during 2012. So there was something a little bit different than the other problems I saw, where the dividends are declared quarterly and paid quarterly. So that means that during the year, you have 4 payments of dividends instead of just 1 at the end of the year. So that makes it a little bit more tricky because the $3 is for the whole year. So you have to take into account, okay, I'm getting 25% of $3 each quarter. So to find the amount, you're gonna have to find the amount of preferred shares outstanding at each of these dates. Then I'm gonna do times 3 and times 25% because it's quarterly. So let me put it down on Excel. So I'm gonna do again a little table. I'm gonna put here the number of shares, the dollar per unit, which is gonna be 3, and the time, and then the total. So my first payment was on March 31st. And on March 31st, there's only during the year 1 transaction that affects the preferred shares. And it is here on April 1st, where preferred shareholders exercise their conversion rights and the company issued 50,000 common shares to them. But that happens the day after, so we don't care for now. So I'm just going to take the number of shares outstanding that's given to us at the beginning, which is 30,000. The dollars per of dividend per preferred shares is 3. and it was 25% of the year, or 3 months out of 12. So my total amount of dividend for March 31st was 30,000 times $3 times 25,000. So this is the dividend paid on March 31st. That's not the dividend for the whole year. We still have the 3 other payments to take into account. Then our second payment is on June 30th. Now on June 30th, the number of shares changes. It decreased, and it decreased because of the conversion here into common shares. It said that the shares were convertible into common shares 5-for-1. So it means that 1 preferred shares can be converted into 5 common shares. So that means that if 50,000 common shares were issued, and 1 preferred shares is equal to 5 common shares, to find the number of preferred shares that were converted, we're going to do 50,000 divided by 5, and that will give us 10,000. So we reduce our share capital of preferred shares by 10,000 when the preferred shares were converted. So that means that my number of shares outstanding on June 30th is now 20,000. We reduced the 30,000 by 10,000 because of the conversion. The dollar per unit stays the same, and the time stays the same also. So now my total dividend for June 30th is 15,000. I'll put this like here. My third payment is on September 30th. And here there was no other transaction impacting our preferred shares. So it's the same amount of preferred shares as on June 30th, and also the same dollar of dividend and the same time frame. So it's going to be the same amount of dividends paid. And on December 31st, same thing. Nothing changed, no new transactions. So I'm going to put it down here. So that means that my total amount of dividends for the year is going to be the sum of everything I paid on every quarter. So it's going to be $67,500 for the year.
I was busy typing down. Why was it 20,000 again?
Because, hold on. What happened on April 1st is that there was a 5-for-1 conversion because the preferred shares are convertible. So since we issued 50,000 common shares and that 1 preferred shares is converted into 5 common shares, if you want to see how many preferred shares we retired during the conversion, we're going to do the 50,000 common shares divided by 5. And that gives us 10,000 preferred shares that we removed from our preferred share stock. So to find the number of shares outstanding on June 30th, you have to do your balance on March 31st minus the 10,000 shares that we converted into common shares during the year. And that gives us the 20,000. I put the little detail here if you want to.
Oh, okay, yeah, okay, minus that, right?
Yeah, minus, because if they're converted, that means that your preferred shares are now becoming common shares, so they don't exist anymore as preferred shares. So you reduce your number of preferred shares in the company, and you're increasing the number of common shares in your company. Like here, we increased it by 50,000. All right. For requirement 3, calculate the amount of the adjusted net income available to common shareholders, which is to be used as a numerator in the basic earnings per share calculation for the year ending December 31st, 2012. So the net income available to common shareholders. When you're trying to find your basic EPS, what's the formula? Anyone want to tell me or write it to me in the chat? If you remember.
So net income after preferred shares divided by the weighted average.
Exactly. So here, Rafi said it was the net income after preferred shares dividends divided by the weighted average common shares. And that's equal to your basic EPS. They're asking us for the net income here. So to find it, it means that we must have like the three other parts of that equation. So we're gonna look the preferred share dividends for the year. Do we have that somewhere, either in the text or in our previous calculations? There's no dividends in arrears for the year, so that's okay. So we don't have to think about that. And even if there was, it would have been taken into consideration in previous years because the shares would have been cumulative. Well, they are cumulative, but it would have been taken into consideration in the basic EPS of the year of the dividend. For this year, we know that the amount of dividend is the 67,500. So that's what we're going to reduce our net income by. Then our weighted average common shares, we also found it earlier in requirement 1, and it was 500,000. So is the basic EPS given in the column? It was. The company basic EPS was 1.204 for the year. So that means that you just have to kind of isolate your net income in this formula to find your net income. So what we're going to do is we're going to do our basic EPS here times our weighted average number of common shares here. And here normally it's minus. So we're going to add back our preferred shares dividends. And that gives us a net income of $669,500. So I just isolated my net income in this formula to find the number. Then we get to our potentially dilutive securities. And they're asking us to identify them and support your answer with appropriate computations and rank these securities where required. So basically, they're asking us to do to find the incremental EPS of all our dilutive securities, and then to rank them to prepare us to do our diluted EPS. What are some examples of dilutive securities? Anyone want to maybe try? It's fine. Just tell me. Is there like any dilutive securities here?
The
Yes.
warrants and put options.
Yeah. So there's the warrants, there's the put options. Is there anything else?
The convertible bonds.
Yeah.
And that's all I remember.
And there's also the convertible preferred shares. So why are these dilutive securities? They're dilutive because they haven't been, like, their impact on the common shares for the year haven't been done yet. But I don't know if that made any sense, but basically at any point during the year, someone that has a warrant could say, hey, I want to exercise my warrant. And if they do, that's going to have an impact on the common shareholders, because either there's going to be more shares available, like in the total amount of common shares, and that might reduce their basic EPS. So they're going to have less earnings per share. There could also be an impact on the net income, whether it increases it or reduces it. So that means that, oh, maybe I'm going to have a higher EPS. So all of these, even though they haven't been really used during the year, they could be used whenever the holders of these securities want. So there's put options, call options, but they're accounted for the same way. So what you want to find is, if they're converted, what would be the impact on the common shareholders? If they are dilutive, that means that it reduces the EPS of the shareholders, well, of the common shareholders. And to find your diluted EPS, it's the lowest EPS that could happen when you take into consideration all of these dilutive securities. So that means that there might be one of those that is not dilutive, and instead of reducing the EPS, it increases it. If that's the case, then that security is anti-dilutive, and we're going to exclude it from our dilutive EPS. So to find their effects, we're going to want to find the income effect of each of the dilutive securities, as well as their share effect. So first, if I start with the convertible bonds, that's my little theory part of the question that comes in. I think I'm just going to copy it. I think it's going to be easier when I just explain it. Give me a moment. Hopefully it works. Formula, keep source from, no. Does not work. Hold on, give me a moment. Didn't copy properly. Okay. Looks nicer in my other Excel, but it's gonna do for now. So for convertible bonds, the income effect, if they were to be exercised, so that means that if the convertible bonds were converted into common shares, income effect is that it increases the income because now you don't have to pay any interest expense on the bond. So what you want to find dollar-wise, it's going to be the after-tax effect of that interest expense that is avoided. So to find the amount, you're going to do 1 minus the tax rate times the par value times the percentage of the bond. So this part without the tax is how you would find your interest expense, like in chapter 14, I think, like pre-midterm, well, during the midterm stuff. So that would be the income effect. So this increases your income. The share effect is if the convertible bonds are converted, how many more common shares will now be available for common shareholders. And that will be the number of bonds times the number of shares per bond. For the convertible preferred shares, the income effect is the dividend that is not going to be paid to the preferred shareholders. So normally, the dividends of the preferred shareholders are paid first to them, and then the remaining of the income is paid to the common shareholders. But now these shares have been converted, so that amount that was reserved, so that amount of income that was reserved to the preferred shareholders is now available to the common shareholders. So that's going to increase the net income. And to find the amount is going to be the percentage or the dollar of dividends times the number of preferred shares that are converted times the par value of the preferred shares. The share effect is the same as for the convertible bonds. So if they're converted, how many more common shares would be issued? And that's going to be the number of preferred shares times the number of common shares per preferred shares. For the stock options warrants, here, their effect, there's no really income effect because you're not really paying any expenses. If there's a stock option, you're not really paying any dividends to the holders of warrants or stock options. So there's no like money impact for if they decide to exercise their stock options. So the effect on income is always 0. But the share effect, well, normally with these types of contracts is that you're going to be able to buy the shares at a lower price than on the market. So for the same amount of money, let's say I have $100,000 and I want to buy shares in a company. If I'm able to buy the shares at $10 instead of buying them at $15, well, I'm going to be able to buy more shares with my $10 per share in my budget than if I were on the market and buying them at $15. So what I want to see here in my share effect is, okay, how many more shares with my budget of 100,000 was I able to buy than if I would have bought them on the market for $15? So to find it, you basically do the difference between the number of shares you bought at the exercise price on your stock option minus or plus, I guess, the number of shares you would have been able to buy with the money you spent on your exercised shares. So to find it, here's my long formula, but we're gonna do it because there's warrants. So we're gonna find it. We're gonna do the calculation. Then after that, to find the incremental, yeah, Rafi?
Isn't you gonna look for it if it's in the money or out of the money first?
Yeah, I'm gonna get to it when we do the warrants. But the people that are holding stock options or warrants are only going to want to be buying and exercises their right if they're able to buy the shares at the lowest price than on the market. So if my my strike price is $10 and the market price is $15, then okay, yeah, I'm able to buy them at a cheaper price. So of course I'm going to exercise. But if my strike price is $20 and the market price is $15, well, why would I buy, why would I exercise it? And why would I buy my shares at $20 if I'm able to buy them on the market at $15? So if that happens, I'm always getting confused with the in the money or out of the money, but if the market price is lowest than my strike price, I'm not going to exercise my stock options, for example, and that's going to become an anti-dilutive security, so we're not going to include it in our dilutive EPS. Once you find the income effect and the share effect, you want to find your incremental EPS, and that's basically the income effect divided by your share effect. And you're going to do that for each of your dilutive securities, and then you're going to rank them. Rank 1, I don't like that, okay. Rank 1 is the lowest incremental EPS that you find. And if you have any stock options or warrants, that's normally your rank 1, because since there's no effect on income, if you do 0 divided by whichever number, it's always 0. So that's always the lowest that you're going to find. And then rank 2 is going to be the second lowest, rank 3 the third lowest, and you go from there until you have no more anti-dilutive securities. If one of your incremental EPS is higher than the basic EPS, then that security is anti-dilutive, and you will not include it into your dilutive EPS calculation that we're going to do after. So you're not going to rank it here. You're just going to say that it's anti-dilutive. Once you've found all your ranks, you're going to add them to the basic EPS following your rank. So if so you have your basic EPS, you have first your income effect and share effect of the rank 1 to your basic EPS, and then you go from there. And every time you're going to look at your new EPS and say, okay, is my new EPS lower or higher than my basic than my previous EPS? And if it is lower, you continue. If it's higher, you stop. And you take the EPS you found before, and that's going to be your dilutive EPS. All right, so let's go back to the problem and let's actually do that. So we said that for this problem, we had warrants, a put option, convertible bonds, and a convertible preferred shares. So I'm going to start with the convertible preferred shares. What is the income effect of the convertible preferred shares? So it's the dividends that we're not going to pay. So the income effect is the dividend amount that we found earlier. It's a 67,500. So if all the preferred shares are converted, you don't have to pay this amount of dividends anymore. The share effect is how many common shares are now issued because of the conversion. And to find that, you do the number of shares outstanding at the end of the year times the number of common shares that are going to be issued per share. So here at the end of the year, we saw earlier that there was 20,000 shares that were outstanding. So that's going to be the amount that we take into our share effect, because that's the amount of preferred shares left at the end of the year that could be converted into at any time in the following year. All these shares can be converted into 5 common shares. So I'm going to do times 5. I'm not done yet. I'm not done yet because we had a 3-for-1 stock split during the year. And what that means is that all of our financial securities that could be converted into common shares, well, at the beginning of the year, I could convert 1 preferred shares into 5. But now there's a stock split, 3-for-1. My shares are now triple the amount than before. So if I converted still 5-for-1, then it's not the same impact as before the 3-for-1 split. Because of the 3-for-1 split, I would be now able to convert them 15-for-1. I do times 3 to the amount of shares I was able to convert before. Was that clear? I need to take into consideration the stock split when calculating the share effect. So here I have times 5, and since now there's a 3-for-1 stock split, I'm also going to do times 3 to triple the amount of common shares because of the stock split. All right, so here what I did 20,000 times 5, well, 20,000 preferred shares times 5 common shares times 3. And the times 3 is because of the 3-for-1. My incremental EPS is going to be my income effect divided by my share effect. And that is 22 cents, 23 cents. My basic EPS was 1.204. So since my incremental EPS is lower than my basic EPS, then my convertible preferred shares are dilutive. So I'll keep them in my calculation. Then I'll do my convertible bonds. The income effect is the interest expense that I'm not going to have to pay after tax. That's what increases my income. Here, they're nice. They're giving us the annual interest expense, so that's cool, but you could also find it by doing this calculation. So here, what I would do 1 minus my tax rate, and my tax rate for the year is 40%. So 1 minus 0.4 times my par value of 3 million time my market interest of 6%. And that gives me an income effect of 108,000. I could also have done 150,000 because they're giving it to us times 1 minus my tax rate. And that should have given me the same thing. Oh, the 6% is the coupon rate, not the, see? Okay, never mind. Getting back. So the 6% here, I took it as my market rate, but it was actually my coupon rate. So here, I have to put the interest expense that's given to us. So the 150,000 of interest expense times 1 minus the tax rate of 40%. So 90,000. Share effect. It's the number of shares now that are available because we converted them. So it said that the bonds are convertible into 60,000 common shares. That means that the way it's written, it's a little bit like confusing, but basically the total number of bonds, like the full amount is, yeah, Rafi.
How you get the 90?
They give us here the interest expense for the year, the 150,000. And when
Yeah, but yeah, I believe that's gonna be wrong because you have to multiply it by 6%. We had the same question at the as an assignment.
Oh, the same as this one?
Yeah, it should be 180.
Because the 6% normally is your coupon rate, and when you're trying to find the interest expense, it's using, because I mean when you're trying to find your interest expense, you're not taking your coupon rate, you're taking your interest rate, so your market rate. But I use the answers to do my answers, and they were using the 6%, so that's why I was using it at first. But I don't think, oh, outstanding at par value, then that means that the amount here that they're calculating is wrong.
Exactly, okay. It should be 180.
Yeah, all right, okay. So think here that the 6% is both the coupon rate and the market rate. So they were issued at par. So we're gonna just use, again, like the way that I was in the solution, just to be like sure at 100%. So it's 1 minus the tax rate times the 3 million times 6%. 108. So here, the interest expense, let's say that it's 6% of 3 million, so 180, I think that you said. Yeah, 180 net of tax. I'll maybe like post it on the group to change like this amount, just so you don't get confused. But is that clear how I got to the income effect and how you would calculate it in an exam? I'll take the silence as a yes. For this share effect?
Yeah, yes, it was because like basically we got the same question as an assignment, but it was like some different numbers between the split. It wasn't 5. So basically we got the same thing. She sent us an email. She was like, I apologize for the 150,000. That's why I remember.
Okay, thank you. Yeah, didn't get the email. So yeah, put here 180,000, then it would make sense. Numbers would make sense. Hopefully that doesn't happen in your exam. I know for my final, when calculating the dividends for the preferred shareholders and the common shareholders, it was multiple choice, and all the answers were wrong. Like for the whole question, everything was wrong. And yeah, like I worked backward and I was like kind of panicking because like I know how to calculate it and it's not working. I don't know what they did with the answer, but they're always redoing new questions, and I don't think they're always double checking. So there could be errors that slip up on the exam, sadly. So to get back, the share effect is 60,000 common shares. So if all the bonds are converted, they're going to issue 60,000 common shares. So that's 60,000. But because of our 3-for-1 stock split, we're going to do times 3. And that's going to be 180,000 share effect. That gives us an incremental EPS of 0.6. So since it's lower than our basic EPS, then it is dilutive, and we're going to keep it. For the warrants, income effect, always 0. So we're going to find the share effect. So we want to see how many more shares am I able to buy if I exercise my warrants. First, you want to see, am I going to use my rights to exercise the warrants? So am I going to be able to buy more shares with my warrants? So you want to come and compare your market price and your strike price on your warrants. So basically what you want to see is, if I'm a warrant holder, I want to convert the warrants when the market price of the shares is higher than the strike price. So I take lower than the market. So we're going to find my strike price. My strike price was $21, but that was before the stock split. So if I'm before the stock split, I was able to buy 8 common shares for $21. So that meant I was able to spend $168, and I would have got 8 shares. But now, for the same amount of money, I should be able to buy 24 shares. So my strike price is now 21 divided by 3, or 168. I can't type. 168 divided by 24. Right? So we divided by 3 to reflect our 3-for-1 stock split that happened during the year. So my strike price is now $7. The market price, it said that the market price is $15 per share before taking into account the effect of the stock split. So I'm going to do the same thing here. I'm going to do $15, and to take into account the stock split, I'm going to divide it by 3. So that gives me a market price of $5 per shares. What's going on here? My market price is lower than my strike price. Am I going to exercise my warrants? Am I going to be buying my common shares using my warrants, or am I going to go on the market and buy them? Yeah, no, you're not going to use it. So because you're not going to be using it, this is anti-dilutive, and you're not going to use it. You're not going to include it in your calculation. For the put options, same thing here. So you want to see what is my strike price and what is my market price, and is my strike price lower than my market price? So the strike price, you were able to buy, well, 1 common share for $18. Now, because of the stock split, you would be buying 1 common shares for $6. So I did 18 divided by 3. Oops. My market price is the same. Did I do that right?
Put option, you have to write to sell at expensive.
Thank you. I always get them confused. Okay, so here, you're not buying the shares, you're selling them at a specific price. So you're gonna do the same thing for warrants when it's call options. For put options, you're able to sell them at your strike price. So you want to sell them when your market price is lower than your strike price. So you're able to sell more. You're able to get more money than if you would have sold them on the market. So my strike price is 6. My market price is still 5. So since my strike price is bigger than my market price, I will sell them using my put options. So what you want to calculate is how many more shares was I able to sell using my put option than if I sold them on the market. So if you would have sold them on the market, if you would have sold them using your put option, you would have sold 15,000 put options. You can sell 2 shares, and the price is $6 per share. So you would have sold 180 shares. That's the amount of money you would have gotten. So that's the money you would have gotten. The number of shares is 15,000 times 2 times 3, 9,000 and say 2. Okay, no. Shares sold with the put option. You sold, sorry, I'm getting mixed up because it's a put option instead of a call option. The number of shares that you sold is 15,000 times 2. And you're gonna do times 3 because of the 3-for-1 stock split. So you're now able to sell 6 instead of 2, so 3 times more. The money that would have been required to, you would have received from that sale, it would have been 190,000 times your $6. If you bought them on the market, if you would have sold them on the market, you would have been able to sell 15,000 shares, well, $540 divided by 15,000 times 6. Hold on. I don't know what I'm saying. Okay, would have, so if you wanted to have the same revenue on the market, so if you wanted 540,000 of revenue, if you sold them on the market, you would have had to sell them at $5, and that would have been 108,000 shares that you would have sold to get the same amount of sales revenue. So that means that the difference between the two is your 108 minus your 90,000. So that gives you a difference of 18,000. So that's the amount that we're going to come and put in our income effect, which I'm going to put here. So my income effect is 0. My share effect is 18,000. And that gives me an incremental EPS of 0. Let me just like put them more clear. So now we have to rank them. So how you rank them? Rank 1 is your lowest incremental EPS. And which one is that? Your lowest? Yeah, go ahead.
Yeah, your put option.
Yeah, your put option. So that's going to be rank 1. Second lowest is your convertible preferred shares. And your third lowest is your convertible bonds. We're not include your warrants because they wouldn't exercise their rights. So that's AD, and that's not included in your dilutive EPS calculation. So that's it for requirement 4. For requirement 5, they're asking us to determine the diluted earnings per share to be reported by the company in 2012. So now what we're going to come and do is for each of the rank, we're going to add them one at a time to our basic EPS, find the new EPS and see if it's lower than the previous one. And if it is, we continue. If it's not, we stop there and we take the previous as our dilutive EPS. So I'm going to first start with my basic EPS, which was 1.24. The income was the 669,000 minus the preferred share dividends. And the share fix was the 500,000. We're going to do our rank 1. The income effect of our rank 1 is 0. And the share effect is 18,000. We're going to add the two together and calculate a new EPS. My EPS, when I take the rank 1 into consideration, is 1.16. Since that's lower than my 1.2, I'm going to continue because the effect of the rank 1 is dilutive. So that means that it's lower than my basic EPS. So I'm going to continue to see if my rank 2 is also lower. My rank 2, the income effects was 67,500 and the share effect was 300,000. I add them together. So I'm just going to add my previous balance here plus my 67,500. Do the same here and calculate the new EPS. The new EPS is lower than my previous one. So that means that my rank 2 is still dilutive. So I'm going to continue to see if my rank 3 is also dilutive. Because you want to find the lowest EPS that could happen. So my rank 3, the income effect was 108,000. Share effect was 180,000. The sum of the two is 777,500. The share effect total is 998, and that gives me a EPS of 78 cents. That's lower than my previous rank, and we don't have any more dilutive securities. So that means that this amount is going to be my dilutive EPS for 2012. Any questions on this question? I see that we're probably going to go over time because an hour to do one question. So if you want to take a break at around 9, we can take like a 10-minute break and then jump back in. But if there's no question, I'll go to section B. So section B.
I have one question.
Yeah.
Where did you get these questions from?
Don't tell the teachers. I found them on Course Hero. On Course Hero, there's a bunch of finals with the solutions available. But one thing you have to be careful on with Course Hero is that there's past final from like 2010, 2011, and the standards for leases and pensions changed since then, so the solution is not accurate anymore. So that's my only like note for that. But if you go in Course Hero, but to be honest, I think we've done like all the problems of the finals that are available on Course Hero. So
Because I'm only worried about chapter 18, to be honest.
chapter 18.
Yeah. Income taxation.
Chapter 18, book problems. I don't like the solutions of the book. If you're able to get your hand, I know you didn't have the assignment for chapter 18, I think. If you're able to ask someone from another section for their assignments problem, and if you're able to do them, that would be great practice. And there should be some past finals on your all sections on Moodle. There should be at least one or two. And then you also have like 3 problems from the tutorials, and there's also problems that I did in the fall that are on the Facebook if you want to go back. So you should have enough problems to be able to practice without going on Course Hero like I did.
Sounds good. Thanks so much.
No problem. For section B, it's about the equity journal entries. So I'll do them. So they're asking us for the journal entries for 1 to 7, and then the dividend declared in 2019. So I'll do them as I read them because I think it's just going to be faster. So they're giving us here the beginning balance of all these accounts. So we have preferred shares, common shares, a contributed surplus on repurchase of common shares issued and outstanding, and our return earnings. So for transaction 1, it says that there were 7,500 call options outstanding on January 1st. The holder of each option was entitled to purchase 2 common shares at $40 each. On that date, 30% of the option holders exercised their right and purchased the shares from the company. So what happened is we issued common shares to the holders of the call options. So what happens is we're receiving their money, and in exchange, we're issuing common shares. The amount, money-wise, is going to be, okay, so 30% of the option holders exercise their right. So that means 30% of 7,500. They were able to buy 2 common shares with each of their options. And they were able to buy them at $40 each. So here I did 7,500 times 30%
I'm
times.
sorry to bother you, but can you just go back to the diluted EPS table? Just
Yeah.
quick. I think I made a mistake.
It's a journal entry, and I'll go back to it. And here is something. Here. Let me know when it's good.
Okay, yeah, he's good.
Okay, perfect. So I'll leave you some time to do the first transaction too.
Yeah, it's not completely the same as the assignment.
Oh, really? Oh, so bad. I didn't know. I don't have access to your assignment. Do you guys still want me to go over it? I'll go over it because just in case, but I'll maybe go a little bit faster since it was your assignment. So on February 1st, they issued 7,000 common shares in exchange for PP&E. That was assessed as 289,000. So that means that they got PP&E asset, and in exchange they issued common shares. So the amount that you're going to put here is the fair market value of the asset. You're not going to put the market value of the shares. You're only going to put the market value of the shares if it is, if the asset was assessed by management instead of like the market, because there's bias in the value of the asset. So if in that case, you would go and take the fair market value of your common shares. On March 1st, they issued common share subscription for 16,400 shares to be issued at $41 each. The subscribers were required to pay $21 on application as the first installment, to be followed by $15 at the second installment and $5 at the final installment. So first, they entered into the contract for the share subscription. So that means that they now have a subscription receivable account, and they also have their common shares subscriber account. They haven't issued the shares yet since they haven't received the full payment, but it's like taking into consideration their financials. The amount that you're going to put here is your $41 that they're able to buy the shares at, times the 16,400 number of shares that could be issued. And also, you receive the first payment on that date. You receive $21 as a first payment. So that means that you receive cash and you decrease your subscription receivable. And the amount that you receive is $21 times 16,400. Then on April 1st, the company repurchased 9,000 common shares for $34 per share and retired them on the same day. So when there's a reacquisition of their own shares, you have to look at if the acquisition cost, so the price that they're paying now to buy back their shares, is lower or greater than the book value of their shares. If the acquisition cost is greater than their book value, you're going to first decrease your share capital account by the same price as your book value. So you kind of cancel the amount that you had in the common share account. Then if you still have a difference, you're going to put it in a contributed surplus repurchase account for the same common shares, and that's only if you have it already in your statements. If you don't, you skip to your number 3, and that's going to be to your contributed surplus, and that's going to be for any like a contributed surplus that we're created for the common share. So that could be options, warrants, etc. But that would be only for the same class of shares. If you have a contributed surplus for preferred shares and you purchase common shares, you wouldn't use that account. And the way that this is calculated, it is distributed proportionately. So what I mean by that is if you have, and if you're repurchasing 100 shares and you have 1,000 common shares in your books, and you have a contributed surplus options of 2,000, the way you're going to calculate the amount that you're going to use for number 3 is you're going to do 100 divided by 1,000. So that's your proportion of shares that you're buying back times the 2K. So that would give you $200 that you put in. And then if you still have any excess, you would put it to your return earnings and as a debit. So you would reduce your return earnings. If your acquisition cost is lower than your book value, you would first attribute it to your share capital again, same price as the book value. And any excess would be to create a contributed surplus account. And that account is what you would use here in step 2 if you repurchase more shares in the future. So here what we want to find is the book value of the shares we purchased. And since we only have the beginning balance, you want to find the value at April 1st. So the dollar value and the number of shares is going to be helpful. So at the beginning, I had a value of 3 million. And I had 112 shares. On January 1st, I added to my share capital, I added 180,000. And that was how many shares? That would have been 7,500 times 30% times 2. So what I did here is 7,500 times 30% times 2 common shares, because they could buy 2 common shares. So we issued 2 common shares per holders. On February 1st, we also issued common shares here, and we issued money-wise 289, and the number of shares was 7,000. And on March 1st, well, nothing affected our common shares account, so there's no effect. So that means that on April 1st, my balance money is 3.8, and the number of shares outstanding is 124,000. So the book, so the dollar per common shares in my book is the 3.8 divided by the 124,000. That means that my book value of the shares is $31 for each. The market price is $34. So my acquisition cost is greater than my book value. So that means I'm going to use this one here to attribute my any surpluses. The difference between the two in dollars is going to be 34 minus 31 times the number of shares that we're retiring, which is 9,000. So that difference is what I'm going to come and put in my 2, 3, 4 steps here. So to start, my common shares, the amount that I'm buying back is $31 times 9,000. Then 2, do I have any contributed surplus repurchase available in my books? The answer is yes. I have it here. I have 55,800. The 55,800 is greater than my difference of 27,000. So that's great. I don't have to go and look and distribute any excess to this. I'm just going to completely put my difference in my contributed surplus and reduce it by 27,000. And that means that I paid cash $34 times 9,000 shares. Add them together. Yeah, that works.
I have a question.
Yeah.
Why you didn't include the subscription?
Because for the subscription, you didn't issue any shares. You only said that you entered into a subscription contract, but the shares weren't issued yet. They're only going to be issued when you receive the final payment.
Okay, sounds good.
That's it for April 1st. So on May 1st, you received the second installment of $15 on this share subscription. That means I received cash. $15 times 16,400, and there was no like subscribers that defaulted on their payment or that got out of the contract. So it's the full amount, and you decrease your subscription receivable by the same amount. Simon, are you okay for to write down everything? I'll take that as a yes.
To tell the truth, I'm very tired and I'm just gonna watch the video afterward.
Yeah,
So
yeah, I think that's a good idea. All right,
I'm listening and not listening at the same time. This is not a good sign.
that's fine. That's fine. You're gonna have time anyways to rewatch the video. All right. On July 1st, the final installment was called in, and 400 subscribers failed to make the payment. So that means 400 out of the 16,400 didn't pay the final installment, and the company issued the shares to the 16,000 that did make their payment. And for the 400 that didn't pay, they basically forfeited the amount. So the company kept the money and they didn't issue any shares in exchange. So first, what I'm gonna do is receive the money of those that haven't forfeited yet, and I'm gonna issue their shares. So I received cash. I received 16,000 times $5. So there was only $5 left to pay out of the 41. Then I'm going to issue their shares. So that means I'm going to reduce my common shares subscribe account, and I'm going to credit my common shares to issue them. And that's going to be 16,000 shares at 41. So we're only taking into account the 16,000 that didn't make the full payment. And for those that forfeited, I'm going to remove the common shares subscribe that I put on the side for those 400 to bring my common share subscribe account to 0. That means I'm going to reduce it by 400 times 41. I'm going to reduce my subscription receivable account because I still have the $5 that they should have paid me. So that means I'm going to reduce it by 5 times 400. And since they forfeited the amount, I'm going to put it as a contributed surplus forfeited shares subscription. And that's going to be the difference between the two, which is 14,400. Or you can find it by doing the first payment of $21 plus the second of 15 times 400. Or you can plug it like I did. So if they forfeit, it goes in your contributed surplus. If you pay them back, so if you do a refund, it goes in cash. And if you do a partial share issue for the amount that they paid, then it's going to go in your common share account or share capital account.
So what's going to happen with the last one?
For the last one here?
Yeah.
Here, I would have just put common shares for that amount.
So your common share.
Yeah, so it would have increased my common shares, but not by the full amount that they were entitled to, only by 14,000.
So 14,400 divided by 41. So you have a 351 common share increase.
It would be divided by 36 because that's the price I paid for it for them. Because they didn't do the last $5.
Yeah, but like you're selling them at 41.
Yeah, but since they didn't buy them at 41, that's not the unit price that they bought them for because they didn't pay the full amount. Here we issued them at 41, but here we're not
Right.
issuing them at 41 because we didn't receive $41.
So you're gonna give them to them at 36.
Exactly. And they're gonna have less shares, I guess, as a result. Yeah, they're gonna have 400. No, they're gonna have the same amount of shares, but at the lower value.
Yeah, that's what I was saying. They will have a like 14,400 divided by 41. They will have a 350 shares. Yeah, because that's what they paid.
Yeah, I mean, both make sense. I'm just used to just plugging it and not thinking about the amount of shares, but it might be asked. Let me check it after the tutorial, and I'll put it on the Facebook group with the recording to see like what's the amount of shares that they would have gotten. Okay. Okay, so that was transaction 6. So we still have one more transaction, which is actually income tax and a temporary difference transaction. So see, they were putting some of chapter 18 into a chapter 15 question. So the company reported a net operating loss of $365,000 for the year. There were no extraordinary or discontinued items. However, an additional depreciation of $850,000 was allowed for tax purposes, which was reversible in future years. So that means that for tax, so the CCA, they were allowed $850,000 more. Further, in the opinion of the management, it was more likely than not that the company would generate sufficient taxable income in future years, assume a 30% tax rate for 2018 and future years. So first, so that happens at year end. I want to find what is my current tax expense. So I'm going to do my reconciliation table. My accounting income is given is 365, and it is a loss. So you're going to put it as a negative. The CCA, they're allowed to take 850 more than what they actually take. So that's going to come and reduce my accounting income by that amount, which gives me a taxable income of $1,215,000. I'm first going to record my deferred tax expense for this year. So since it's negative, it's going to be a deferred tax liability. Oops. Yes. And the amount is going to be my temporary difference, which is 850,000 times, since we know my tax rate for future years, it's going to be times 30% instead of our 40%, I think that I was. So times 30%. Then, since I have a taxable loss, that means that I can carry it forward instead of just losing it. There's no mention that there was taxable income, any profit in previous year, and they had to pay taxes in previous year. So I'm just going to carry forward the full amount. So that's going to create a deferred tax asset and a deferred tax benefit. And the amount is going to be my loss, taxable loss, times my future tax rate of 30%. That I can apply against future tax expense. As for the transactions, then they're asking us to determine how much dividends for each groups. So the preferred shares were non-cumulative, but participate in excess of a 10% dividend on the common shares. These shares had been issued several years ago when the company was incorporated. Dividends for any given year are determined on the number of shares outstanding at the end of the year. Dividends on preferred shares were last declared in 2015. The company's management wishes to offer a dividend of 14% to its common shareholders. First thing that I noticed, the preferred shares are non-cumulative. So that means that we don't care that they didn't declare it in previous year. So we're just going to be paying the dividends for the current year for the preferred shareholders. We're not taking into consideration any dividends in arrears. Then we have to find what is my ending number of common shares and preferred shares to find my balance. I need to find the dollar value and the number of shares. So if I start with the preferred shares, there was no changes, no journal entries that affected my preferred shares balance during the year. That means that my balance is, I have 48,000 outstanding for 1.2 million. For the common shares, we're going to take back my little calculation that I did here. And I'm going to add any transaction that happened afterwards. So after February 1st, we repurchased 9,000 shares. So that means that we decreased our share capital by 9,000 or by 279. So I'm going to put it here. Then May 1st, no change to my common shares account. July 1st, we issued the common shares to the subscribers that paid us in full. So that increased the common shares account by 656,000 or 16,000 number of shares. But that was on July 1st, I think. That increased it. And there was no other impact to our common shares balance. So that means that at the end of the year, the account is at $4.2 million or 131 shares. Then they're telling us that the company wants to offer a 14% to its common shareholders. So that means that the dividend for the common shareholders should be 14% of the 4.2 million here. So it should be $590,000. So I need to take into consideration that I need to also pay my preferred shareholders, well, their dividend for the years, which is $1.50. And also, since they're participating in excess of a 10% dividend, I'm also going to give them a 4% dividend to get them to participating to the 14%, like the common shareholders. So they're only getting a dividend on top of the $1.5 if the common shareholders are getting a dividend that's higher than 10%, which is the case for this year. They're getting a 14% dividend. So my preferred shareholders and my common shareholders. First, I'm going to calculate my preferred shares dividend for the year, which is 2019. So the amount is $1.5 times 48,000. Then I'm going to do a 10% dividend to my common shareholders. And that's going to be 10% of the 4.2 million. Then I'm going to do the 4% dividend to both the preferred shares and the common shares. So that would bring the common shareholders to a dividend of 14%, which is what we want. So here I'm going to do 4% times 1.2 million and 4% times 4.2 million. That gives me a total of dividends for the preferred shareholders of 120,000 and for the common shareholders of 590,000, which is the same that we wanted. So the total amount of dividends that should be declared is the sum of both. So it should be 710,940. So here it's 10%, here it's 4%. All right, if you have questions, let me know. But since you had it in your assignment, my guess is that it should be fine. Then we're gonna jump into chapter 18. So chapter 18, income taxes. I think personally it's the hardest chapter of your final. So like I told you, Rafi, like practice as much as you can, and you do have a lot of material with the tutorials and with the assignments that you had in class. All the assignments, I think, are past final questions. So that gives you a good gauge of how hard the questions will be on your final. Things that you should know for chapter 18 is the reconciliation between your accounting income and your taxable income. That includes what's the current difference, what's the temporary difference, how do you calculate your current tax expense, and how do you find your deferred tax assets and deferred tax liabilities. You also need to know how to account for any carry backwards and forward. And also what happens if you have a tax rate that was enacted in advance versus enacted in the current year. So when you have like tax rate changes. I'll write it down. So reconciliation between taxable income and taxable income. That includes your permanent, temporary, current tax expense, DTL, carry backwards, that's only 3 years back, and carry forwards, that's 20 years. Future. And change in tax rate. For ASPE, what you need to know is you can use both the deferred income tax method or the future income tax method. And if you're using the deferred, everything is non-current. And if you're using the future income tax, the current versus non-current depends on the underlying asset. So if you have a warranty that's supposed to be reversed in the next year, then that amount of future income tax is going to be in your current. If it reverses in 3 years, then that's going to be in your non-current. For IFRS, you only use a deferred tax method. And like I said here, everything is non-current. A tip to know if it's a liability or an asset. This is like if you don't know how, like you're doing your like reconciliation table and you just don't know if it's a DTI or if it's a DTA. If the sum of your temporary differences is positive, it's going to be a DTA. If the sum of your temporary differences is negative, it's going to be a DTL, so an asset or a liability. So a DTA means that you're paying more taxes this year, but in the future, when the temporary differences reverse, you're going to actually be paying less taxes because of that reversal. So it's benefiting you in the future. That's why it's an asset. For the liabilities, you're paying less taxes this year. So your taxable income is lower than your accounting income. But in the future, when the temporary differences reverse, you're going to be paying more taxes. If you're not doing your reconciliation table for the expenses, if your expense in your book is greater than what you paid, it's a DTA. If the expense in your book is smaller than what you paid, it's a liability. For the revenue, it's the reverse. If what you booked in in your income statement is lower than what you paid, it's an asset. And if the revenue is greater than your cash, it's a UTM. That's a pretty quick summary of the chapter. But
Can you say the permanent differences?
yeah, so permanent differences are anything that are non-taxable under tax laws. So that could be, I put examples in my slide, but it's really like dividends on Canadian corporation. You cannot include that in your taxable income. You cannot include under tax laws 50% of your meals and entertainment expenses that you booked in your net income. I'm going from memory. Life insurance premiums on the CEO. If you put them as an expense in your books, you cannot expense them in your taxable income, so you would add them back. There's others, but in your problems, they should tell you that they are non-taxable for tax purposes, or they're not deductible for tax purposes, or only a certain percentage is deductible for tax purposes. You're not in 440, so you're not supposed to know them by heart. You should just be able to know, like, okay, what are my clues and my problems that are telling me that that's a permanent difference. And they're a permanent difference because they're never going to be accepted under tax laws. So they're never going to be included in your taxable income. So there's no like reversal of the difference in the future. It's just never accepted. But if you check, no problem. If you check, oh, sorry.
So basically chapter 18, it's like we calculating the difference between like the UCC and the, for example, our depreciation, like, you know?
Yeah. So you're calculating what is my difference between my financial reporting and my tax. That's all you're doing. The biggest difference is depreciation in CCA, what you're talking about for the asset, is different under financial reporting and tax. So that's always going to be one of the difference that you see. The other ways that differences are created is because that under financial reporting, you're using accrual method to record your expenses and revenue. So you're matching your expenses to your revenues for the year. So when the service was actually provided is when you're going to book it. Whereas under tax, you're looking at when did I receive the cash and when did I pay cash? So you're only looking on the cash side. So that's why subscription revenues, when you receive the cash in advance, but you haven't provided any services, you need to remove it from your books. No, you need to add it. Like you're going to record like an unearned subscription revenue in your books, but you actually receive the full amount of cash. So you want to add the full amount of cash that you received in the year. And that's going to create a temporary difference. Was that clear? So you're basically just accounting for the between the two.
Yeah, I got it.
Perfect.
Because that's the way I look at it. Like I follow the cash.
Yeah. And that's how it's going to make sense in your head when you do the problem. Because if you're trying to do it as like, okay, I have depreciation, I always deduct it. Well, I guess it's fine. But why am I deducting it? It's because I want to remove its effect to add the actual CCA for tax. I want to add the depreciation for tax. So you want to like tell yourself, what did I do?
It's basically because under CCA, if you go into taxation, you just take 4%. And like that's amount, for example, let's say 4% of something, it's 30,000, but you have a lifetime. If you divide it by 10, like your depreciation 12,000 in your book, but in your taxable income, it's 37,000 or 30,000. So the difference gonna create kind of UCC, I guess, after it's gonna be recapture or something when you say it in your taxable. But like that's for taxable income, not accounting.
Yeah, exactly. So you want to take the difference between your CCA and depreciation to get to your taxable income. So let's jump into the problem. So BCD Inc. following ASP reported accounting income before tax of $405,000 for the year. ended December 31st, 2016. Additional information relating to income taxes is as follows. So the depreciation for the year was 205, and the CCA claim was 194,000. I'm going to do it as I'm reading. So first they're asking us for the journal entries for 2016. So I'm going to do my reconciliation for 2016. My accounting income was 405,000. I don't know yet if I have any temporary differences, so I'm going to put it there, but there might be some, there might not be some. And my temporary differences, I'm going to put them down. So it says here that my depreciation was 205,000 for the year, but under tax laws, it should have been 194. So I do it in two steps. You can do it in one step, just plug the difference. But what's going to happen is you're adding back your depreciation expense of 205, and you're adding it back because you deduct it to get to your accounting income. So you want to cancel its effect. And you're going to remove the CCA, which should have been your depreciation under tax. So that gives you a temporary difference of 11,000. Since the difference is positive, it's going to be a deferred tax asset. Then cash remitted to the pension trustee for the year by BCD was 270,000. Pension expense recorded by BCD was 280,000. For tax purposes, the cash remitted to the trustee are deductible as pension costs. There were no previous timing differences related to the pension plan, and the accrued pension liability at the end of the year is considered non-current. So what happened is you paid cash 270,000. So that's what you want to deduct for your tax. But in your books, your pension expense was 280,000. So you're putting in as a positive to add back to get to your taxable income. So the temporary difference is 10,000 positive. So that's also a deferred tax asset. Then they say that life insurance premiums of $12,000 on the insurance policy on the life of the CEO officer of BCD was paid by the company, and which is non-deductible for tax purposes. So see here, it says non-deductible for tax purposes. So that gives me a cue that it's a permanent difference. So life insurance premiums. So that means that they expense the premium in their books. So I'm going to add it back. And since it's a permanent difference, there's going to be no journal entries. Then they say that on January 1st, the government unexpectedly changed the income tax rate from 30% to 25%. So my tax rate for the year is 25%. If I'm going too fast, just let me know. On that date, BCD had a 200,000 cumulative timing difference related to warranties, with the amount of warranty expense exceeding the warranty cash disbursement on the date. So that means that I'm going to want to adjust my timing difference for the warranties to reflect the change in tax rate. So I'm going to want to decrease it by 5%. And it says that it's expected to reverse in equal amounts during 2017 and 2018. On the December 31st, 2015, the net book value of the capital asset of BCD was 800,000, and the amount reported on the December 31st, 2015 tax return, UCC, was $730,000. So that again is another temporary difference that we're going to want to come and reduce by 5%. But first, before I do all of that, I'm going to find my current tax expense. So my taxable income for the year is the sum of all these numbers together. And my current tax expense is 25% of 150. So since they're using ASPE, they're not really telling you if they're using the future deferred income tax method, but since I know in the problem they're asking for the split between current and non-current, I'm going to use the future income tax method to do the journal entries. So for my current tax expense, the transaction is provision income tax, right? And the credit is income tax payable. And the amount is 39,500. Then I'm gonna count for my 2 temporary differences for the year. You can do 1 journal entries, you can do 2. I'll do 1 because I think that, no, I'll do 2 because I think that if you're able to see me do 1, you'll be, if you see me doing 2, you'll be able to do just 1 on your exam. So first I'm gonna do my journal entry for the 11,000. So that's gonna be a future income tax asset to my provision income tax future. And the amount is going to be 25% times 11,000. And then for my pension, it's going to be the same transaction, but a different number. Now it's going to be 25% times 10,000. You're not done. You also need to adjust for your 2 temporary differences that were in your books at the beginning of the year. So first, if we look at the warranty, the temporary difference was because the warranty expense was bigger than what they paid. If your expense is bigger than what you paid, that means that it is a DT. So we know it's the DTA. The amount that's in your DTA account is the 200,000 times the tax rate that they knew at the beginning of the year. So that was times 30%. You want to bring it so it's 200,000 times 25%. So you're going to decrease your DTA by 200,000 times 5%. The other leg of your journal entry is going to be your, oops, I put DTA, but it should be, I'll fix it. The other leg of your journal entry is your provision income tax future account. And here it's supposed to be future income tax asset. And it's going to be the same amount. For your book value versus CCA, they're giving us the book value of 800,000. And we have a UCC, which is like, if you haven't taken 440, it's like the book value for tax purposes. So what's the leftover amount of value of your asset that you're gonna use the CCA on? It's 730,000. That means that you have a difference between the two of 70,000. Now, when you have a depreciable asset, what often happens is that you're going to be taking more UCC in the first years and less depreciation. So that means that you're going to set up at the beginning a liability. And then when the amount of depreciation starts to be bigger than your CCA, then you're going to come and reverse your liability. So that means that here, technically, I should have reduced my liability to take into account the fact that I set up a liability at the beginning. It's not the end of the world if here you put asset, because it, when you're doing your balance sheet, they cancel each other, they go all in one account. But because here we're trying to find what's what account we're trying to reduce by 5%, you have to think, okay, what's the account that I set up at the beginning when I first got this asset and when I first took out some CCA and depreciation on it. So I repeat, usually we take more CCA in the beginning. So you set up a DCL because your expense would be smaller than your tax. So that means here, my in my books, I had a DTL of 70,000 times 30%, but I want to bring it down to 70,000 times 25%. So I want to come and reduce my future income tax liability by 5% of 70,000. And that's going to go also in my provision income tax future account. Any questions for this one? Because I know it's not as logic as the other ones. And also, not scare you, but I'll scare you a little bit. This is very important. Like the logic behind this is important for ACCO320 because it's going to come up like all the time. So just be ready for that. For requirement 2 is to prepare the income statement for 2016. So my net income before taxes is my accounting income for the year, which was 405,000. I had my provision income tax current. So my current tax expense was 39,500. My provision income tax future, I'm going to take into consideration all my transaction. So be careful here, because if it's a positive, it means that it increased as the debit. That means that here I add this one. No, what am I saying? I reduce this one. I subtract this one. I'm going to add my 10,000 and I'm going to reduce it by my, well, 3.5. Okay. So that gives me a total tax expense of 40,750 for the year. Wait. Okay, here I didn't add my last pension expense, so my taxable income was lower. So my actual current tax expense for the year is 109,500. So just correct that. That means that here my total tax expense for the year is 110,000. So my net income after taxes is the 405 minus 110. So 294,250. Then they're asking us to split the balance of my deferred tax accounts between current and non-current. So we have 3 temporary differences. We have our warranty, we have our assets, so the difference between my depreciation and CCA, and we have our pension expense. The beginning balance of all my temporary differences, for warranties, I had a beginning balance of 60,000 in my account. So it was 200,000 times 3%. Okay. For my asset, I had a beginning balance of 21,000 and it was a liability, so I'll put it as a minus. And for my pension, I didn't have a beginning balance. The temporary difference for 2016, there was no temporary difference for warranty. There was a temporary difference of 2,750,000, that decreased my liability. So I'll put it as a plus. And for the pension, it was 2,500. Then for the 2016 change rate, I decreased my warranty account by 10,000. I decreased my asset account by 3,500, and there was no change for the pension. So my ending balance of each is 50,000, a 14,000 liability, and a 2,500 asset. So for my FIT asset and my current and non-current, for the warranty, how is it split? It says that for the warranties, there's equal reversal amounts in 2016 and 2018, 2017 and 2018. We're in 2016 right now. So I mean that half is going to reverse next year and the other half is going to reverse in 2 years. So in my current amount, I'm just going to put half of this amount. And my non-current, I'm going to put half of the 50,000. For the asset, it's not an asset. As for the asset, it's not an asset. So I'm not going to put anything here. And for the pension, it said that the timing difference related to the pension plan is considered non-current. So I'm going to put the full amount as non-current. For the liability, when it comes to depreciation versus CCA, always put it as non-current. So you just have the full amount as non-current. So that means if I net them out, I have, well, my asset is bigger than my liability. So my FIT asset, the current amount will be 25,000. And my non-current amount will be 25,000 plus the 2,500 minus the 14,750, which gives me a total asset of 37,750. Any questions? Because I feel like I went kind of fast. No?
Like, do you think we're gonna have a net income statement since it's MCQ?
You might ask it a lot in the exam, so be ready for it.
Oh shit.
Yeah, but your exam is multiple choice, so you can kind of gauge like that. They might just ask what is the net income after tax amount for the year, or they might ask what is your provision income tax current amount for the year and future amount for the year. That might be how they split it in your exam. Do you guys want to take a break because we're halfway, or do I continue? No answers. Let me just go fill up my water and I'll be back. Okay.
All right.
All right, so for section B, we're talking about carry forwards and carry backwards. So as you saw, like in the past tutorials and this one, there's always two questions. There's one where you're gonna have to do the journal entries for the year for your temporary differences and maybe like a tax rate change. And then you're gonna have a question on carry forward and carry backwards. That's all the exams I saw, it's always these two questions that come back with like different amounts. So be ready for those. Oh. So West Limited began operations on January 1st, 2016. They reported the following amounts and information for 3 years ending December 31st as follows. So we have the accounting income, we have the depreciation expense, we have CCA for the year and the tax rate for each year. Assume all changes to future tax rates were enacted on January 1st, 2016. West Management is confident that it is probable that the company will be able to use any tax losses carried forward. So we're going to do all the income tax related journal entries for the 3 years. And we're going to calculate the gross amount of the loss carried forward for 2019 and the future. So I'm going to start with the journal entries for, no, I'm going to start by finding what is the taxable income for all 3 years. So I have 2016, 2017, and 2018. The accounting income is 550,000 minus 1.4 million and 200,000. Then they have the depreciation expense. I'm going to add back for all 3 years. So I'm going to put it as a plus to cancel its effect. And they had CCA, which I'm going to deduct to get to my current tax, my taxable income. So minus 170, minus 170, minus 100,000. And that gives me my taxable income, which is going to be the sum of all of these. The tax rate for 2016 is 25%, 2017 is 30%, and 2018 is 30%. Let me just change this here, change this here. That gives me a current tax expense for 2016 of 120,000. For 2017, I'm not going to have any because I have a taxable loss. And for 2018, it's going to be 60,000. So let's start with the journal entries for 2016. So first, I want to take into consideration that I do have a temporary difference of 70,000. So I have a DTL of 70,000. And I also have my current tax expense. I'm going to put them in the same journal entry. So I'm just going to do one. So I have my current tax expense of 120,000. I will have a deferred tax benefit because I have the DTL of the sum of my temporary difference times my future tax rate because the tax rate was enacted in 2016. So I know that in the future, my tax rate is 30%. So I'm not going to set it up at 25. I'm going to set it up at 30. I have my DTL, same amount, and my income tax payable of 120,000. So for 2016, it's fine as of now. It's nothing out of the ordinary. For 2017, we have a temporary difference again, but we also have a loss for the year. So that means I'm going to be able to carry it backward to 2016. I could have carried backward to 2015 and 2014 if we had the information. But I'm going to carry it back to 2016 and get a refund on the tax expense that I paid for the year. So I'm going to get by my 120,000. And then if I have any amount left over that I can carry forward, I'm going to do that. So first I'm gonna account for my DTL. So the amount is, I think, the same as the other one. So the sum of your temporary difference times your future tax rate of 30%. And here DTL. Then to get back the tax expense I paid in 2016, I'm gonna have a income tax receivable and a current tax benefit of the amount that I paid, so 120,000. Here, you have a receivable because you're gonna receive the money. Here you have a benefit because you set up an expense in the previous year, so it's kind of canceling the effect of the expense of 2016. Then I want to see what is my balance forward. When you're trying to find your balance, only look at the taxable income, because see here, you didn't pay the same percentage tax rate as you would pay in the future years. So you want to come and look at my taxable income, how much more of my taxable loss is available after I apply my taxable income of the previous year. So I have a taxable loss of 1,470,000 minus the 480,000 taxable income from 2016. So I have a balance to carry forward of 990,000. So I'm going to set up a DTA of 990,000 times my future tax rate of 30%. And that's going to be a deferred tax benefit. For 2018, I'm gonna have to pay taxes in 2018. I'm supposed to pay $60,000. But since I have a carry forward amount that I can apply against it, I'm gonna use it so I don't have to pay any taxes for the year. So what I'm gonna come and do is I'm gonna reduce my deferred tax benefit and reduce my DTA by the amount of taxes that I would have paid. You can find if, I know that I can take out the full amount because my balance was 990,000 and my taxable income for the year is 200,000. So it fits in my balance. But if I had a taxable income of 1.5 million, then I wouldn't have paid taxes on 990,000 of that 1.5 million and only paid tax on 1.5 minus this amount times 30%. So that means that my balance of to carry forward after 2018 is 990,000 minus 200. So it's 790,000. So they're asking for the gross amount, so that's why I didn't take any tax rate. If they ask for the net amount, you can do this times 30% or the future tax rate if you know them. Any questions for this?
You don't have to multiply it with 30%.
No, because they're asking for the gross amount. If they asked for the net amount, you would have done times 30%. All right, so for question 3, so question on pensions. Like I said earlier, be careful for if you're doing past exam for pensions because the standard changed, I think, in 2014 or 2015. So finals that are like from 2015 and older, like you might see in the solution that it's not done the same way as you do it now. That's because the standard change. So just be mindful of that. And there's not a lot of finals available from after the standard was released. So if you check my final, my previous semester tutorials from the fall, it's the same problems I did in both the chapter 19 and the final, because I just have 3 problems that I can run through. But I think the book problems are good for this chapter. So you can do them too as a practice. So for this question, it says that you spent a lot of time presenting all your work and reasoning in an organized manner. Now it is evening time and time to go home. Just while you were hoping to sneak away quietly without being noticed, the familiar voice boomed out. Bully boy leaving early, eh? Remember my famous word, no hard work, no pay. I want you to quickly deal with this pension stuff before my morning meeting. If you work diligently at it, I am sure you can get it done by 10 tonight. Besides, you only be wasting your time in front of the TV, and Sal, now you have the golden opportunity to learn something new. And with that, your plans for a dinner date faded away rapidly. So this is public for you. I think they're a little bit more nice than this, but this is public accounting. And I'm going into public, so got nothing to complain about, I guess. Mr. Count pulled out a ragged-looking sheet of paper with several holes punched all over it. See Exhibit 1. So we have here the pension sheet, and we're missing some numbers. So we only have the cash amount here, and we only have the expense total here. So the rest we're going to have to figure out with the information that they give us. I have it in my Excel. Oh, you can't see it all. Okay. So last night I accidentally gave this worksheet for the annual accounts of our pension plan to my grandson. Clever kid he is, just like his granddad, who was practicing using the new paper punch machine I gave to him as a birthday present. Mr. Count informs you that the sheet had holes where they out to have been figures. Since he did not have the time to reconstruct the worksheet, he was happy to hand it over to you. He offers the following additional information from his memory. The discount rate, as well as the expected rate of return on plan asset, was set at an annual rate of 5%. So that's going to be used to find our interest costs and our return on assets. Then you were unable to see any figures for the beginning balance of either the defined benefit obligation or the plan assets, as these had been punched out. Other numbers were equally mutilated, so we don't know our beginning balance here. Every odd numbered year, which is this year, we're in 2015. Yeah. So this year, the defined benefit obligation arising from the plan's operation were remeasured. For 2015, he recollected that the actuary revised the DBO. He estimated this would have been to be increased by 10% of the actual ending 2015 balance just before this adjustment. That means that here, we need to increase whatever we get. The sum of this needs to be increased by 10%. This increase was recommended based upon his estimates of the lower mortality rate of retirees of the plan. So that's kind of sad. People are dying earlier. The plan assets produced an actual return of 4.5% for 2015. So my expected was 5%. My actual was 4.5%. In search of information, we sent out 2 emails, one to the treasurer and the other to the plan administrator, provided some quick response from both. The treasurer was able to send you the following figures. So the total actual return on plan assets for 2015 amounted to 29,700. So my actual return is 29,700. And she confirmed that she had remitted $120,000 towards founding the plan. So that means that you paid cash $120,000. Which increased your plan asset by the same amount. The current service cost amounted to $105,000 for the year. So here, $105,000. And the past service costs incurred on January 1st amounted to $30,000. So since they were incurred on January 1st, I'm going to include them into my interest cost calculation. If they were not, then my interest cost would have just been my, I think it's DBO. Interest cost is DBO. Yeah, it would have just been my DBO time my market rate. He apologized that he did not have any prior year end balance readily on hand, but did remember that the fund was underfunded then by an amount of 175,000. So that means that here, the difference between the two is 175,000. And since it's underfunded, I'm going to put it as a negative. All right, so first thing that is in my mind is that we have our actual return. We have the actual return rate, which is 4.5%. To calculate your actual return, you take your beginning plan asset times the actual return rate. So that means that we're able to find this amount here by doing 29,700 divided by 4.5%. So that gives me a beginning balance of 660,000. Since here, it was underfunded by 175,000, my DBO was greater than my plan asset by 175,000. So that means that it was this plus this was 835,000 at the beginning. Current service cost was 105, so I'm going to put it here as a negative. And past service cost was minus 30,000. I can find my interest cost. I can find it by doing my market rate of 5% times my beginning balance of my DBO plus my past service cost. I'm adding my past service costs because they were incurred on January 1st. If they don't tell you that, then you're not adding it to your interest cost calculation. So that gives me an interest expense of 43,000. And I'm going to put it here as negative. For my net return on assets, I know that my actual return was 29,700. My expected return was my beginning plan asset times my market rate, which was 5%. So that means that it is my 660,000 times 5%. So my expected return is 33,000. So that's what I'm going to put as my net return on asset. And I want here to increase my plan asset by the actual return, so 21,700. To do this, you need to add back in my OCI because we're using, I guess, IFRS. Does it say anywhere that we're using IFRS? Doesn't say, but since the number was punched out in OCI, then we're using IFRS. So you're going to put it in your other comprehensive income. And that's going to be 33,000 minus 29,700. I'm putting it as a positive. So the net impact is minus 29,700. Then the benefits paid. Benefits paid. How much they pay? Oh, they paid 156,000 towards existing retiree claims. So they paid out 156,000. So that decreased your DBO because you paid it out, and that decreased your plan asset because you took out your investment to pay out. Then my actual aerial loss on DBO, we said here, where was it? Here, it said that the actual ending of 2015 was 10% more than what was calculated with the impact of the journal entries. So that means that here you want to increase your DBO by 10%. So you're going to add all of this together and you're going to do times 10%. And since we're increasing and it's a liability, we want to increase our liability. To increase a liability in this worksheet, you put it as a negative. So the amount here to increase is a negative. And here in your OCI, your loss is going to be a debit, which is normal. A loss is normally a debit. And it's a loss because you're going to have to pay out more money. So you're losing more money. That's all the numbers that we're missing. So we just have to find our total values for each. So my total for my expense was 145,000. For my OCI, it's going to be 89,000. For my cash, it was already given. The increased from the cash is 120,000. That gives me an ending balance in my accrued post-retirement asset liability of minus 289,275. Here it is an ending balance of 942,975. And here this was already given. So let me just check if it works. So my sum of all of these is 653,700. Checks out with the ending balance that we were supposed to add. And if I check the difference between the two here, it is 289,275, which is the same as this amount. So it works. Any questions on how I got one of the numbers before I do the entries? No, so let me do the journal entries. So first you're gonna have your pension expense. You're gonna have your OCI, and that's gonna go in your accrued post-retirement asset liability. Pension expense is 145,000. Your OCI is 89,000. So that means that your account here is just the sum of the two. So it's 234. Then you have your funding entry. So that's just the cash amount that you paid. So your debit is this account, this long account, and then you credit cash because you paid out 120,000. So it's the amounts that you have here. That's it for question 3 for leases, for pensions. And then finally, do you have questions on pensions?
Can you just tell me how you find the plan asset and the DBO? I just missed it.
Yeah, no problem.
Because-
So for the plan asset, we were given the actual return rate, and we were also given the actual return amount. So here,
okay.
so I just
Yeah.
divided this by this, and I got this. And then I was
And
able
you like, okay, sounds good. Thank you. And for
Yeah.
another question, because we had the quiz on chapter 19, and actually it's so confusing because they don't state, because basically this amount, some of them should be credit, some of them should be debit. But in the quiz, they don't state whatever credit, whatever debit, They say on your worksheet, it's minus 6.4. Okay, you can't say minus 6.4 as an expense, It's actually credit. But yeah, that was how they presented in the quiz.
Yeah. In your worksheet, any amount that's a negative, see here, I have in my expense a negative. But it's a credit amount, and it's going to come and reduce my expense amount for the year. So
Yeah,
any amount that's negative, it's going to be a credit, and any amount that's positive is going to be a debit.
Yeah, I know that, but the question was saying what's going to be the journal entry, and there was 4 option, plus 14, minus 14, plus 6.4, minus 6.4. you can't have a journal entry with minus 6.4. You know, that's stupid.
But I mean, some people might not have like caught on to it and put like the minus instead, you know? That's how they get you with multiple choice questions. But at least you got like 2 like out of the way right then. But
Yeah, I got it. Like it was minus 6.4 because like after she put the solutions, like I assumed that because like it's impossible, it's debit, and it was the only choice.
oh, okay. Well, good job. I don't know what the quizzes are at all. But yeah, be on the lookout too for your final. For those little things. For question 4, for leases, again, leases, the standard changed, and I think it changed in 2016, something like that. Actually, the question I'm showing you, the solution was with the old standard. So if I have any calculation errors, just let me know because I did it using the new standard. So what you need to know for leases, you need to know lots, sadly, but the focus will most be on lessees for the final because lessees, the journal entries are more variable depending if you have an unguaranteed residual value, guaranteed residual value, BPO, they could be a different tax rate than a lesser. And so normally they're going to ask you for the lesser, the first journal entry, and then it's kind of done. Whereas for the lessee, they're going to ask you for the first journal entry, the journal entry after 1 year, the journal entry when the contract is ended. So there's a lot more to know for the lessee. For the theory, you need to know the criteria for IFRS and ASPE to capitalize your lease for both the lessee and the lesser. You need to know when to include the unguaranteed residual value, the guaranteed residual value, and the BPO in your calculation, and when and how to depreciate the lease asset. You need to know a lot more, but that's like the overall view of the chapter. The criteria for the lesser under IFRS, it's that if the lease is less than 1 year, or the minimum lease payment is less than 5K, they have the option to have an operating lease. That an operating lease means that there's no capitalization of the asset, so you're not like selling your asset and go straight into your P&L. So it goes straight into your net income. So when you receive the payment, you book it as a lease revenue. If not, then it's going to be a finance lease, and it's going to be as if you sell the asset. So you're going to record a sales revenue. Well, depends if it's a sales or manufacturing. And you're going to have to decrease. You're going to have to remove your asset from your books. You're not going to take any depreciation on it anymore. So since the lesser, you also have to check for sales type versus direct financing. If it's a finance lease, sales type, it means that the fair value of your asset is greater than your book value. So you have like a profit and you're going to record your sales revenue. If it is a direct financing, you just have no, so your fair value is going to be equal to your book value. So you're going to have no COGS and no sales account. You're going to have your receivable, you're going to have your decrease in asset, and then you're going to have your unearned interest revenue. For ASPE under IFRS, for ASPE for the lesser, they have to meet these two criteria. So they must expect reasonably predictable payments from the lessee, and they have no uncertainties regarding future costs to be incurred. If one of them is not met, it's an operating lease. If one of them is met, again, we just add the third criteria, which is, does the lessee have a BPO, or they keep ownership at the end of the lease term? Is the lease term at least 75% of the useful life of the asset? And is the present value of the minimum lease payment at least 90% of the fair market value of the asset? If one of the three is met, then then it's a finance lease, and you capitalize it. So it's going to be the same as here. For the lessee, under IFRS, it's the same as for the lessor. It's just that for the operating lease, they're not going to book revenue, they're going to book a lease expense. And if not, it's going to be a finance lease, and they're going to like buy the asset. Here I said it was finance lease, but under ASPE it's operating lease. No, it's capital lease. And then under ASPE, for the lessee, you only have to look at these three criteria. So that's it for the theory. We're going to see the journal entries while we do the problem. So for the problem, Concord Corporation leased the construction crane to Vanier Construction on January 1st, 2011. The following information relates to the lease agreement and the leased asset. So here we have the costs of the asset, the normal selling price, useful life, lease term, salvage value, unguaranteed residual value, the minimum lease payment, the lessor's rate, and the lessee's rate. The crane will revert back to the lessor at the end of the lease term. Title does not pass at any time to the lessee, and there are no options for a bargain purchase. Both companies use the straight line amortization method. Both have a December 31st year end, and both have adopted IFRS. The lessor agrees to bear all executory costs. So required, or saying that you could do an amortization table, and when there's no journal entries for your opinion, you're required to state specifically why. So first, we're going to classify the lease from the viewpoint of both corporations, giving specific reasons for your answers. So first, I'm going to for the classification, they both use IFRS, so I'm going to be looking for both at this year. Right? So is the lease less than 1 year? The lease term is 7 years. So no. And is the minimum lease payment less than 5K? And the MLP is 31,000, so that's no. So for both, it's going to be a finance lease. For the lessor, you have to look, is it a sales type or direct financing? Your fair market value of the asset is the 146,000 here. and the book value is the 100,000. So the FMV is greater than your book value by 46,913. So that means I can be a sales type lease. Then they're asking us to do the journal entries for the lease as at January 1st, 2011 for the lessor and the lessee. I'm going to do first the lessor. For the lessor, since it's a sales type, I'm going to have my lease payment receivable. I'm going to have a cost of goods sold. I'm going to have a sales. I'm going to have a decrease in my asset, and I'm going to have an unearned interest income. The lease payment receivable is your minimum lease payment times the number of terms plus any unguaranteed residual value, guaranteed residual value, or BPO. Your COGS is the book value of the asset minus the present value of your unguaranteed residual value, guaranteed residual value, or BPO. And your sales is your present value of your minimum lease payment plus your present value of the guaranteed residual value, or BPO, and minus the present value of the unguaranteed residual value. Your asset is your book value. And this is a plug, or you can find it with the amortization table that we're going to do too. I know Professor Denali does the table first and doesn't use the formula. It's okay, it comes back to the same thing. I'm going to do the table and I'm going to do the formulas, just so you're less confused. But first, I'm going to do it the way I like to do it. So first, what I'm going to do is I'm going to find the present value of my minimum lease payment. So to do that, I'm going to have my future value as my unguaranteed residual value, which is 10,000. Since it's the lesser, add any unguaranteed residual value, your guaranteed residual value, or your BPO, regardless if it's unguaranteed or guaranteed. You always add that as your future value. Your K is going to be their own rate. They always use their own rate, so their rate is 12%. The N is 7, and the payment amount is your 31,200. So I mean that your present value is the payments are made at December 31st, so it's end of the period. So your present value is your 146,913, and would you look at that, it's the same as your fair value of your asset. So to do your transaction for your lease payment receivable, I'm just going to do the formulas here. So I'm going to do my MLP of 31,200 times my N of 7 plus my unguaranteed residual value of 10,000. My COGS is my book value of my asset, which is 100,000. And I need to find my present value of my unguaranteed residual value. So the P, I'm going to put it here, the PV of, that means that my future value is 10,000. 7, K is 12%, and PV is let me just check if that's right. Yeah, 4,523. So I'm going to come and subtract it from my COGS. My sales is going to be my present value here minus my present value of my guaranteed residual value. My asset is 100,000 value. And here I'm going to plug it. So I'm going to do the sum of my debits minus the sum of my credits. And it's 81,487. If you want to do the table, I'll do it here. I don't use the same terms. I don't use like the technical terms. So pardon me, but you should be able to follow. So on January 1st, 2011, you had a lease payment receivable of the PV of your minimum lease payment. On January 1st, 2012, you paid 31,200. You had a 12% interest on your beginning balance. So that means that you had a discount of the difference between the two, and you come and subtract it from your beginning balance. You're gonna do that up until January 1st, 2018. Okay. So here there's some rounding. Oh. So here you see on your last minimum lease payment, you're gonna have in your books your unguaranteed residual value. That's gonna be left over. And that unguaranteed residual value on the same day, you're gonna reduce it in your book when you get back the asset, and you're probably gonna record a gain or loss depending on the actual residual value of the asset. So it's gonna be 10,000 minus 10,000, so you would have a lease payment receivable amount of 0. Here, your 81,487 comes from the sum of all the interest income that you're gonna do for the year. So 81, this checks out. Any questions on how I calculated anything?
You don't do the interest for the last 10,000?
No, you don't do it because it's end of the year. So that means that you already calculated for your year 2017 here. So you don't need to calculate it again. If it was beginning of the year, you would calculate it because your interest, you would have paid like 31,200 plus the 10,000, I think.
Yes.
Yeah.
Because it's 0, it's not 1. Okay.
Exactly. All right, for the lessee, I'm again gonna find the present value of the MLP for the lessee. So the difference with the lessee is that since it's unguaranteed, they don't include it as a future value because they're not gonna have to pay it out. It's unguaranteed. If it was guaranteed, that means that they guarantee the lessor that they're gonna have an asset of 10,000 to give back to them. And if there's any difference between the two, then they're gonna have to pay it out. So if the residual value was 5,000 at the end and they guarantee the 10,000, then they're gonna have to pay 5,000 back to the lessor. So here it's unguaranteed, so I'm gonna put 0. If it was guaranteed or a BPO, I'm gonna include it. For the market rate, under ASCII, for IFRS, if the lessee knows the lessor rates, they take it. If not, they use their own. But here, there's no mention that the lessee, oh, yeah, there is. The lesser implicit rate known to the lessee, so they know it, so they're gonna use it. If lessee knows lesser rate, use it. If not, use their own rate. So here's gonna be 12 because they know the lessor's rate. 7, 31,200. So my present value is going to be $142. So excuse me if because I didn't think that they knew, so my answers are a little bit different, but I think that's right. For their journal entry, they're going to record a leased asset because now they have a leased asset, and they're also going to record a lease obligation, and that's going to be your present value of your minimum lease payment, so the $142,389. For the table, here they're going to put the present value of their MLP. They're going to have minimum lease payment of $31,200 for 7 years. Their interest is going to be 12% of the previous book balance. It means that it's going to be a discount of $14,000. So here, you see that here we have the 10,000 left to reduce our lease obligation. Here we don't have it, and we don't have it because it was unguaranteed. So at the end of the lease contract, the lessee, all they do is that they give back the asset to the lessor regardless of what the new residual value of the asset is. They're not going to pay more if the value was less than anticipated. So they have no further payments after they did all their minimum lease payment. If there was guaranteed value or a DPO, you would have paid it here, like we did for the lessor. And I'm not sure how you find it. Oh, to find, I guess with the table, to find your leased asset, it's your discount amount here. So the $142,389. And if you had I guess I should have put it here. If you have a guaranteed residual value, it goes here too. So it would be added to your leased asset. So that's it for 2. For 3, prepare all the journal entry at December 31st, 2011. So for the lessor, what's going to happen is that they're going to receive cash, and they're going to decrease their lease payment receivable. The cash that they receive is the minimum lease payment of $31,200. They're also going to record some of their interest income that they earn for the year. And that income is found in your table, and it is going to be the $17,000 here. For the lessee, they're going to have an interest expense, and they're going to have a reduction in their lease obligation. And the cash is going to be the minimum lease payment. Interest expense is found using the table, so it's going to be the $1,786. And here it is a $14,000, or you can just plug it. So the sum of the two is equal to your minimum lease payment. They also need to depreciate the leased asset. So to know how you depreciate it, if you have an unguaranteed residual value, you do the book value of the lessee divided by the lease term. So that's what we're going to do. If you have a guaranteed residual value, it's the book value of the lessee minus the guaranteed residual value divided by the lease term. And if you have a DPO, It's the book value of the lessee divided by the useful life of the asset. So here you're not using the lease term, you're using the actual useful life. And that's because you're going to buy it at the end of the contract. So you want to depreciate it for the full life of the asset. So since we have an unguaranteed residual value, our depreciation expense is going to be the book value of 142,000 divided by the lease term, which is 7 years. For the requirement 4, prepare the entry for the lessee upon the end of the lease period. However, assume the entry for the payment of the lease installment has already been made and that is not required. So what that means is this journal entry here has already been made. So the last minimum lease payment has already been made. What they want you to do is realize that since it's the lessee and there was an unguaranteed residual value, they don't have any further journal entries to do once they've paid out this. If there was a guaranteed residual value or a BPO, they would have a second journal entry to do at the end of the asset, at the end of the contract, but it's not the case. So for 4, journal entry of the lessee at the end and the minimum lease payment entry has been made. There's no journal entry because they don't have any guaranteed residual value or BPO to pay out. Was that clear why there's no journal entries? I mean, you could, yeah, you can do that. Or you can also say that there's just a depreciation expense entry if they haven't already did it, which is just going to be the same as this one. Because they don't say that the depreciation expense has been taken. For requirement 5, assume for this question and question 6 only that the lease agreement contain a guarantee from the lessee for the market value of the leased asset be returned to be $10,000. Determine the amount at which the lease will be capitalized on January 1st, 2011 by the lessee and the lessor. So for the lessee, it means that here, this calculation here, they have a guaranteed residual value of $10,000. That means that they're going to record their asset at $146,000. For the lessor, it doesn't change anything because they're already taken into consideration the 10,000. So it doesn't. For 6, in question 5 above, prepare the entry required to be made by the lessee upon the return of the crane at the end of the lease term, assuming that the market value was $7,200. So that means that their lease obligation at the end of the contract will be equal to their 10,000 guaranteed residual value. So that's what they're going to remove from the books. They're going to remove the 10,000 guaranteed residual value. They're also going to remove from their books the leased asset at its fair market value. So the leased asset has a fair market value of $7,200. So here they're going to have a loss of 10,000 minus 7,200, because there was a guaranteed residual value. See here at 4, we didn't record any entry for that, like for the difference between the, because we didn't really care because there was no guaranteed residual value. All right, for 7, assume for this question only that the lease agreement contained an option for the lessee to purchase the asset at a BPO of 10,000. Determine the amount at which the crane under lease will be capitalized on January 1st, 2011 by the lessee. And at which the lease will be capitalized by the lessor. So for both, it will be the same as the guaranteed residual value. So that doesn't change anything. For C, of the amortization on the leased assets, I guess it's what's the amortization on the leased asset that will be recorded on December 31st, 2011. So for BPO, how you amortize it, it's your book value divided by the useful life. The book value of the leased asset will be the same as the guaranteed, so the 146. The useful life of the asset is 10 years. So your depreciation amount is going to be 146 divided by 10. Then finally, assume for this question only that both parties follows ASCII, and also that leasing to the lessee was higher credit risk for the lessor. Prepare the entries for the lessor on January 1st, 2011 and December 31st, and for the lessee same dates. So first, I'm gonna do the lessor. Just copy the criteria. So they have to meet one of those 3 criteria. Does the lessee have a BPO or keep ownership? This is for this question only. So we're not taking here like we're just taking the first facts of the case, and they didn't have a BPO and they didn't keep ownership at the end. So this is no. Is the lease term at least 75% of the useful life of the asset? So the lease term is 7 years, useful life is 10, so that's 70%, so that's no. And is the present value of the MLP at least 90% of the fair value of the asset? And we saw earlier that the present value of the minimum lease payment is the same as the fair value of the asset. So that's yes. So there's one of the 3 that's fulfilled. But since we're looking at the lessor, we also have to look at these 2 here. So are they expecting reasonably predictable payments from the lessee? We saw here that leasing to the lessee was a high credit risk for the lessor. So that means no, they don't. And because it's no, we don't even have to look at this here. It's going to be no too. Because of this, it's going to be an operating lease. So everything is booked through the P&L. So on January 1st, there's going to be no entry. Because normally on January 1st, what you do is like as if you sold your asset, but you still have your asset in your books. So nothing's going to happen. And then on December 31st, you're going to have your cash and lease revenue that you're going to have from the lessee, which is your 31,200. And you're also going to have your depreciation expense, which is going to be your 100,000 minus the residual value, not minus this salvage value of 4,000, because we're looking at the lesser, so they're keeping the asset in their books for the full asset life, not just for the lease, divided by 10 years. And for the lessee, we're just going to be looking at these three. So here it's still no. Here it's still 70%, so it's still no. And here we have to be careful because under ASPE for the rate, I think since under ASPE, they take their own rates. So they're going to use 15% to find the present value of the MLP. So that's going to be 15%, 7, 3,200, future value of 0, because it's unguaranteed, 0. And the fair value of the asset is 146. That means that it's 88%, so that doesn't fulfill it, so it's no, so it's going to be an operating lease. Which means that on January 1st, 2011, there's going to be no entry, because normally they record the purchase of the asset. And then on December 1st, they're only going to record their payment for the lease, which is going to be lease expense to cash for 31,200. And no depreciation to do and no interest to do because it's an operating lease and they don't have the asset in their books. We're done with the final review. Any question? I know it was a lot longer than it should have been, but hope you're still awake.